You. You. I got mine, you get yours.
So it's 17 days in 2024. The Hang Seng Index is down 9% year to date. The Hang Seng Tech Index it's down 16% year to date. Alibaba down 12%. And for myself, I'm down a total of $24,429 on my Alibaba position. Of course, if you were to add back the dividends that I got just last year, it comes a little bit under 24,000. So I think I'm just going to show a very quick screen grab of my portfolio holdings now. You pick 10 stocks, 2 is probably going to go to shit, 7 of them are probably going to be okay, and 1 of them would really go to the moon. And evidently, that is something that I've personally experienced thus far as well. So I think in 2024, I'm just going to continuously focus on rebalancing the allocation on a portfolio level and probably read up a lot more in terms of the theory and understanding of how to best optimally allocate your capital and I guess in a way try to still strive for long-term returns. So I know that many of you actually follow me just to get your daily dosage of a confirmation bias. Particularly so when the stock is essentially crashing. The Hong Kong market, or at least the China index in general, hasn't really been performing. And a lot of investors are getting impatient, they're getting exasperated, and insert whatever vocabulary you have here. So here's a Hang Seng Index chart returns created by Bunti that was pretty beautifully done. So this is the last 36 years worth of returns for the Hang Seng Index. And you can see from 1988 to 2023, there are a total of 14 negative return years out of 36. So in any given year, presumably the probability actually hold true, there's a 39% chance that you will experience some sort of a negative return, while there's a 60% chance that you'll get a positive return. But I know the most initial and most intuitive reaction that I'm going to get is that, hey, how is that possible? Take a look at the last 6 years. We have experienced 5 bear markets in the last 6 years, from 2018 to 2023. Of course, 2024 is not looking too good. We don't really know how 2024 is going to shape out in the coming year. So just take a look. Any investor that sat through 5 negative return years in the past 6 years, intuitively, nobody's going to trust the stock market, or nobody is going to trust that particular market or index in general. So I guess I'm just stating the facts as it is. How you're going to interpret it, that's up to you. So I think just to give a brief commentary on why the Hang Seng is down by such a large extent, there were two key factors that were cited by the media.
Weibo has recently introduced a new method that will help us take away our emotions from our investing journey. So you can now automate your investments via their regular savings plan to essentially help you save both time and energy on things that actually matter in your life. So Weibo's RSP currently supports US listed stocks, ETF, and SGD USD denominated mutual funds. So new year, new me. So I've personally kickstarted my dollar cost averaging plan into the SPY every month with Weibo. And for those of you who wish to do the same, you can sign up for a Weibo account with the link down below. Oh, and there's something that I wish to mention as well. So here's the screenshot from my Weibo account where I've received my cash voucher from participating in the previous Moneybo campaign. So for those of you who have missed it, don't worry. Weibo has decided to extend this offer with even lower requirements today. You just have to fulfill 2 key steps. First, tap on participate now and complete an initial funding of any amount during the campaign period. Second, subscribe to Moneybo and maintain the net cumulative deposit amount until the stipulated event period. And you will be able to enjoy cash vouchers worth between 80 to 3,000 US dollars. So don't miss it this time around. Sign up with the link below now. Thank you Weibo for sponsoring this video.
So firstly, it's of course about the real estate bubble in China. It does seem like it's a gift that never stops giving. Data coming in showing that the housing slump has actually worsened by a large extent. And I think the second more important factor is probably what we are more concerned with, is that the domestic demand internally in China is still extremely repressed and people don't seem to be spending any amount of money at all. I think the caveat here is although the GDP target is actually on target of above 5% that's set by the CCP, but that said, I think at least in the real estate development space, the investments is actually down 9.6% year on year. And this is on top of a much lower base in 2022 because we know that this correction in the real estate market has been playing out for at least the last 2 to 3 years already. Next up, I think in terms of the retail spending, it's actually up 7.4% year on year. Some of you might think, hey, it's good enough, but at least based on estimate consensus, it should be coming in at least 8%. And that's also on top of a lower base in 2022. And one more important factor that some investors tend to forget is really the idea of a deflation risk. So if I can quote from the chief China economist at Morgan Stanley, so this is the deepest and longest deflation in China since the 1998 financial crisis. So CPI, which is the consumer price index, it fell for 3 straight months, while the producer prices actually dropped for 15 months straight. So I think initially, when deflation came into the headlines back in the Chinese economy, many investors were very excited because this means that China, being the largest producer of the world, they can export deflation to the rest of the world. And we have seen it come into fruition over the last 12 to 18 months, where many other countries have been benefiting from this deflationary impacts from China. But that said, as we move over to the next phase of consumption, more and more countries and companies are actually worried from this lower aggregate demand of goods and services from the Chinese people. Because let's not forget, China as an economy, even though they are producing and they're exporting a lot, they're also importing and consuming a lot from external vendors and external export countries as well. So this whole idea of China slowing down, benefiting the world, I think it might be transitory, and more people are now more concerned, particularly so for many of our MNCs like Apple selling iPhones, Starbucks selling coffee, and even Tesla selling cars and EVs back in China. So many of these companies might take a hit if China continues to post such disappointing results. So some of you might then ask, what are we supposed to expect from China today? Is it going to be a lost decade? Is the stocks not going to perform at all? Are we going to see more and more years being populated on the left side of the diagram? I think the short answer is I don't know. Nobody knows. And it's getting more and more polarized on both sides of the camp. You can see that there are some people that are still adding to their position. And particularly so, there are some interesting traders that came into the scene and saying that Baba is a good buy. On the other hand, you have long-term, or at least those that like to believe that they are long-term, back holding the positions. Thinking that, this is transitory in nature, 3 years, 4 years, 5 years, regardless of how long this bear market is going to be, they're probably going to diamond hands and continue staying vested. So I've recently came across this podcast episode by Professor Scott Galloway, and I'll play a short clip from it.
The thing here, from someone of your perspective, is what this represents is the greatest intergenerational theft in history. And that is, in 2008, when we had the great financial recession, we bailed out the banks, but we allowed the economy and other stocks to fall. And Amazon and Apple got hammered, as they should have been. And that happens. The markets are cyclical. Now, your opportunity to buy into a depressed market was in 2020 when we had a pandemic. But instead, the government said, I know 1 million people dying would be tragic, but what would be profoundly tragic is if the NASDAQ went down and rich people got less rich. So they flooded the market with $7 trillion in not only your money, but on your kids' money and your credit card and your future to bail me out and to ensure that my stock stayed high. So you have never had the opportunity as you come into your prime earning years to buy Amazon or Apple at $7 a share, which is the opportunity I got as I was coming into my prime income earning years in the earlier part of the millennium. So this was the greatest intergenerational theft in history. And because we have decided that we're a NIMBYist rejectionist society that just wants to put more money in the pockets of seniors because our government is run by ridiculously old people, younger people haven't had a chance to take advantage of market cyclicality and buy in cheap. I got that opportunity. You should have had that opportunity 2 years ago. And instead, we said, no, Scott needs to stay rich. So young people in their 20s and 30s, you. You. I got mine, you get yours. That was nothing but exceptional theft between generations.
So I think it's very, very interesting when Prof. Scott actually used this term, intergenerational theft in history. You basically steal the opportunity from younger people to accumulate shares because as market move in cycles, at least in the down cycle, you would like to encourage more people to accumulate positions and to basically put their capital into the markets to harvest the equity risk premium. Of course, the context here is Prof. Scott is talking about the US market. I'm not too sure whether this is applicable to the rest of the world and whether in the Asia market, in the Chinese market, in the Indian market. But I think this is really just a food for thought for those of you out there that are probably feeling very lost, feeling exasperated, not knowing what to do with your position. So in retrospect, I sometimes wonder, at least based on my reflection when interacting with people much older than me that have experienced the '08 crisis, the '98 crisis, even if the opportunity is served in front of you, do you have what it takes to actually seize it? I don't know. But if you look at it from a broader perspective, history don't usually repeat itself, but it often rhymes. And regardless, whether it's in 1998, in 2000, in 2008, in 2020, the outlook tend to look bleak and a lot of people will be giving up. So I'm not advising you to do anything. I think for those of you that can read between the lines, I think you should know where I'm coming from. So last but not least, I'm just going to briefly cover what I'm intending to do in this carnage in the Hong Kong market. I think I just wanted to draw back to one part of history where I basically shared that I bought 95 BABA shares in the US market at $79.98. And a lot of people have came back and said that, see, you're so stupid for buying it so early. Baba share price is going to continue to tank and stuff like that. So I think the whole thought process of me buying Baba that time was pretty simple. I was actually just switching my position from KWEB to Baba. So I essentially exited my KWEB position. I took the loss on KWEB. I think it was a realized loss of close to $700. And I then entered the position with my KWEB proceeds into Baba. So it was really just a switching, and I can basically show you the chart that shows my KWEB journey. I've been buying down, and I have a pretty okay position on KWEB. I think it's around 5 to 6%. I exited it at around $27.60, and I took the proceeds. I top up a little bit. I think I top up around 1,000, and I bought more Baba. So it was not necessarily me pumping or injecting new funds to it. I'm just switching the allocation, and since they're both China, you can see that the KWEB share price has also tanked by a pretty large extent as well from the time I sold. So I guess it kind of negates each other. So now the bigger question, am I going to inject new funds into Baba again? I think for now, I still remain neutral. I'm not particularly excited unless Baba creates new lows, maybe to under $50 or under $40. And when it gets that low, I probably have to make an assessment and to renew all my models and my understanding of the company on why the market is tagging such a low valuation multiple to it. Because let's not forget, Baba also has a lot of cash on the balance sheet. After the reassessment, if I think it's a good risk reward, then yes, I might enter new positions and pump in new funds. But if not, I think the focus, at least for this year, is still to allocate a lot of my new capital and to build out my US position and to allow my China position to do its own thing. If it goes up, good for everyone. If it goes down, then naturally by allocation, it will go slightly lower. That said, I think especially in this kind of high volatility environment, what I'm doing, in fact, is rather than buying the shares outright, I'm basically selling puts. I'm just collecting premium and just looking at the price action. And if it rebounds, I'll usually tend to close it. So people that are closer to me will know that I'm doing it. But if not, generally, I don't recommend anyone to just go into options without really understanding it. I'm still experimenting and I'm still learning the ropes of the market. But at least on the idea of selling puts, so I kind of have results looking pretty promising in 2023. But let's not forget it was a bull market in the US market. I'm still trying to experiment and testing it out with some of these Chinese counters as well. So I think that's just generally my take on many of these Chinese companies in 2024. I know this video might not sound as inspiring as before. I'm telling you guys that, hey, let's rally together and let's buy more stocks. But I think at least from my own perspective, portfolio allocation starts to become a bigger issue as I contribute more and more funds. You tend to think twice or think thrice by saying that I'm going to go 100% into a particular stock, or worse still, I'm going 150% just because it's cheap and going to margin. So I think going to leverage is still a red line that I'll probably never cross, and I'm still holding steadfast to all of my Chinese position. With that, I'll see you guys in the next video, and hopefully 2024 will be the time that we'll see each other on the moon. Goodbye.